going to start with quick introductions in case anyone hasn't met any of the investors before, and then we'll get kind of into topics. The way we're going to structure is we'll probably spend the first 25-30 minutes just going through some questions as I try to be the best host possible for this event. And then we'll open up to questions to everybody as well. All right, Nate, you're up first if you want to introduce yourself.
Hey everyone, good morning or good afternoon. I'm Nate Cooper. I run Barrel Ventures here in Chicago. Noted I am a Bears fan and Cameron is a Packers fan, so this is very hard for us to do together. We invest in anything that touches food in any way, as I say, pre-farm to post-fork and everything in between. We've done ingredients, packaging, supply chain, commerce infrastructure, ag tech, and then brands as well. On the brand side, we're well known for investments in Olipop and Go Nanas and Love Corn and Block Snacks, but happy to help any way I can.
Awesome. Yeah, and me and Nate's relationship is a good kind of lesson for everybody that even if an investor passes, you can still stay close with them and they can be a good ally as you continue to grow your business. All right, CJ, you want to go next?
Sure. My name is CJ Fowler or Carlton, call me both. I'm one of the founders of Goat Rodeo. We do a lot of beverage, both beverage alcohol and traditional. We do food. We do quite a bit of commerce tech or commerce infrastructure, as Nate pointed out. I come from a brand building background. Probably have gotten quite a few of these people on the call intoxicated one way or the other, as created high noon before I moved over to the capital allocation side. And we're excited to be here to answer some questions.
James, do you want to add anything to that?
I'm just the smarter, better looking partner from Go Rodeo. So it's nice to meet you all. Yeah, that's a great synopsis of everything that we look at and what we like to do. I come from more of a finance background.
Awesome. And then last but not least, Genevieve, if you want to go, just a quick background.
Genevieve Gilbreath, co-founder of Springdale Ventures. We invest in anything consumer. So looking at consumer brands really across the spectrum, I think any durable goods that you could bring into the home to make life better, whether it's food, beverage, things like Caraway is one of our non-food beverage investments. We love the supplement space. So we've invested in brands like the Absorption Co. and First Day. On the food side, Block Snacks with Nate and Goodles is another one of our great food brands. We really do seed to Series A, seed rounds where there's already some traction. Very, very, very rarely have we done a couple pre-revenue deals, but looking at brands that usually have between $1 and $10 million in revenue and kind of have a balanced eye between profitability and growth. My background is I've been in consumer product space for about 20 years now, mostly as an entrepreneur for the majority of it. Had two different supplement companies, and then jumped over to this side of the table.
Awesome. Well, now that we got introductions out of the way, Genevieve, let's start back with you, and I'll kind of facilitate our first question, which is gonna be very broad. But what's the overall feel? I mean, we work with hundreds of brands here. I'm talking brands on a daily basis, but I think there's some frustration and stuff in the market in terms of just kind of how the investment landscape is right now. But would love to kind of start with all of you, and Genevieve, we'll start with you. Like, what's the overall feel of kind of the level and just the environment right now for brands that are looking to raise, especially in that, I would say most of the brands right now, kind of that seed, or starting to think about potentially a Series A.
Yeah, I'm sure it's no shocker that capital markets are really tight right now, and it's been a really tough time to raise. I feel like, we've had some really kind of unprecedented events that have happened over the last 4 years, and that's really shaken the market up from every which way. And I think we could, kind of analyze where we were, but where we are now is, there is money out there. It's starting to move a little bit more freely than it did last year. I feel like it's still pretty constrained, and it's just really hard, especially early stage, to find capital. We're doing kind of, we have capital, but we've invested less this year than we have in past years. And yeah, I'll leave it at that for now. I can add more color later.
Yeah, and then CJ or James, I'll let kind of one of you kind of add to that, but let them know kind of like what you're seeing, what the general feel is. That'd be great.
Go ahead, James.
think Genevieve did a good job of covering it. It's tight. Right now, there's what I'll call flight to quality, and that tends to happen more so at the growth stage. What we're seeing is brands that have made it through that difficult, challenging phase from seed to maybe post B, where the margins that you're projecting you're going to get to have been established. The supply chain is your supply chain that you're going to have through the end of your journey. There's no more growing pains projected. And now you've got a very efficient marketing wheel. Like we're seeing a lot more funds that would have previously been willing to take risks, allocating more so towards the growth stage, which has been kind of an interesting development over the last, call it 18 to 24 months. And then secondarily, what I'm seeing is, there are brands who are being successful raising, and they tend to be kind of club rounds. So we're seeing, it's whereas in the past, maybe you could win a single VC over, and Genevieve and Nate, you guys can probably weigh in on this as well, what you're seeing amongst, our colleagues in the space. But more so, I'm seeing people who are going and saying, hey, if this thing is going to require 10 or $15 million, from now until exit, can we collectively fund that as opposed to I'm willing to take a chance knowing that the next round we're going to have to rely on a third party that's not in the conversation right now. So we're seeing more club rounds taking place too. So those are the two things that are standing out to me. CJ, anything else?
I mean, I'll try and put a slightly more positive spin on it. I agree with everything everyone said, but I think this is at least an opportunity for especially earlier stage companies that are seeing some traction to do the proper amount of introspection on should I raise, right? Because no one here's a economist. Yeah, liquidity might start coming back into the environment, but I think that there's still a recency bias that if liquidity comes back in this environment, it's going to start to look like 2018 through 2000, end of 2021 again, and it's not going to. That was the anomaly. So the companies that quote unquote should be raising are, maybe it's a little harder, maybe the valuations are a little bit lower, but if you demonstrate very clearly that you have the 3 or 4 things necessary to attract capital, the system's still working. So I think this is an opportunity for a lot of companies to decide, should I remain in lower growth, get my either margins or customer acquisition cost or my narrative around my addressable market refined enough such that when I am really ready to raise, I'm doing so in an environment that maybe is a little bit more friendly.
Yeah, Nathan, anything to add kind of on top of what James and CJ are saying?
Unsurprisingly, I have a little harsher view of it, and I'm going to be less gentle. For those who know me, it's not surprising. I think it comes down to the tourist money has left the market, quote unquote, the dumb money, and with that, dumb valuations. And so, I think too many people view venture capital as a solution when it should be viewed as a tool, right? Broad strokes, if you are building a good, responsible business and you have reasonable thoughts on valuation, you will likely be able to raise money, whether that's bank financing, friends and family, private equity, venture. Like venture capital, I think, is a very specific tool used for a very specific type of business, right? The type of business that wants to get explosive growth, within 5 years, like go from 0 to hundreds of millions of dollars of sales, which I think is very rare. For every 1,000 businesses you look at, there's probably going to be 5 that really fit that. That doesn't mean you won't be able to raise a different type of financing, but I think venture should be viewed as a tool, not a solution. And just because venture is not right, it doesn't necessarily mean that you don't have a great business. Right? Some of the best businesses in the world didn't raise venture capital.
Yeah, the prerequisite for raising isn't that you are burning money. The prerequisite for raising is that you can deploy venture capital incredibly efficiently.
So let's stay on that topic then. What are the kind of, and Nate, we'll go back to you for this and start with you on this one, but like, what are the thresholds or key metrics that you're looking at? I think a lot of these brands have been told, especially this year, like, hey, like just march towards profitability. And I think some of the some brands might have done that at the cost of growth, and then they're going to get into that investor conversation, and then investors are going to look for both, right? Like, hey, how did you both prioritize kind of that march towards profitability, but also, you know, not subsidize any of your growth? You know, what are you seeing as the KPIs that you're really looking at, especially kind of given the macro environment?
I think in the categories that we're looking at today is like, does your product taste good first and foremost, right? Because if you don't have a tasty product, whether it's a food or a beverage or something that people are going to want to try and come back to, like, you've got nothing. So product and brand, and then gross margins. Can you make money selling this, or do you at least have a path to making money selling this? And then, you know, you sort of get into all the other categories, which is how big is the category, right? Is this a category where if you get 10% market share, you know, it's a substantial business, or is it a category where if you get 10% market share, you're a $10 million business, right? If that's the case, venture capital is not right for you guys. If you're going after a, you know, a massive category and 10% of $10 billion, you get to $1 billion, like that's a really big business. But if you're going after a really small category, venture is probably not right.
And then Genevieve, over to you, kind of what are you seeing as those thresholds or KPIs that you're looking for, like as you look to deploy capital outside of, you know, your current portfolio?
Yeah, I mean, spot on to what Nate said. And no, we're definitely very interested in unit economics, gross margin, contribution margin as well. A lot of times people will have a decent contribution margin, especially in the businesses that are more D2C focused, but they'll have a negative contribution margin. And that, you know, that really starts to sink the business as well. So looking at those things, and I think, you know, that balance between growth and profitability is definitely something that we're looking at. We don't expect businesses that are kind of sub 10 million to necessarily be profitable. Occasionally you'll come across some that are, and that's fantastic. And of course we love that. But that is certainly not the norm, especially depending on what category you're building in. You know, different categories are more cash intensive, but seeing that there's a, you know, a good path to good growth and contribution margin, that the company and the founders really understand their financials. We run into that a lot, where we'll have a couple bump into companies that have a great brand, great concept, great messaging, but just really don't have a good grasp on unit economics or financials. There's one other thing that you know, I think even if they're not profitable now, but just really understanding what it's going to take to get there is super interesting to us. It's like, you don't have to be there when we put money in, but like, do you really understand what it's going to take to get there? And can you show us a financial model and like a, you know, a unit economic bridge that'll get there? So that not only, you know, tells us that it's possible, but that you know how to do it.
Is there like a red flag that you've seen that kind of comes up in that process where like, okay, they don't have a handle on this? Is it just like not allotting enough for trade spend, not understanding what levers to pull, not understanding how they're going to deploy the millions of dollars in capital, or is it a collection of all?
All the above. And then also, you know, when you're out raising capital, we've had this happen a couple of times recently, is we'll be given a financial model and then it turns out that it's both historical and future, and then it's kind of wildly inaccurate, and they just kind of gave us the wrong one. So make sure that when you're out raising capital and you're giving materials to investors, that everything is the most updated and consistent.
Okay, and then CJ and James, I know you talked about just, you know, brands needing to know if they should raise capital right now. Like, anything to add into like what are the kind of mistakes that you're seeing when they're showing their KPIs, and like what kind of thresholds you guys are looking for, or what type of story you're looking for to kind of stand out here?
I mean, I'll go back to your original point in the question, which was a lot of people have been told to search for profitability. And the way I would actually characterize that more specifically as the search for efficiency, right? So, you know, if you went through a system where the overall time period was overcapitalized, as people focus on profitability, you're going to essentially slough off all that excess growth that wasn't efficient. So I can be extremely attracted to a company that might have on the lower ends of growth, but they're tremendously efficient with their cash, and they're reinvesting in the business, out of that. I can be attracted to a company that has, towards the top end of the range on growth, and as a function of that burns a little bit more, but the unit economic story has a very clear walk to where that efficiency will get reclaimed kind of at a higher level. To me, it's not, it's not a direct focus on profitability. It is, does your margin structure, does your velocity, does your customer acquisition cost lend itself to a business that will scale and begin to work without having to have outside capital close that gap?
I think on top of that, like just a little bit more surface level, like in terms of just like capturing the attention of a new investor, right? Like whether it's like, hey, we have a PO from this retailer, or we have this X amount of traffic, or like we have this part of our nutritional panel or our protein level, like whatever that makes you different from a product standpoint, like what is going to catch your attention right now? Because like obviously this is stuff that like you'll get through in the second, third conversation during due diligence, but just from a surface level, like you're getting a lot of pitches, you're getting a lot of introductions, like what cuts through the noise right now? And CJ and James, I'll go back to you to start. Like what's this winning story? Because I think in CJ and James, we talked a little bit about last week, like everyone's pitching kind of the same story and gets a little bit lost in the sauce right now. So like, what do you think is just a good way to capture that initial attention before you hopefully present these strong kind of things that are gonna be the backbone of your story?
Go ahead, James.
Momentum. And it's how you like clearly describe that momentum. Like, Nate made a great point that like not every business is right for venture capital. Venture capital serves a purpose like once you've started to hit an inflection point, and that's when you can best use the capital. So it's saying, hey, here's how we've like it's a very clear and concise explanation of here's where we've gotten with the resources that we had. With additional resources, here's where we'll go. And by the way, we have commitments to get it. So it's, saying like Cam, your point, like maybe it's bringing POs. It's like, hey, we have authorizations in Kroger next year. We need capital to fund that working capital to get it going. And Kroger is just the tip of the spear because X, Y, and Z is going to unroll the next phase of our grocery expansion. So I think it's about being able to concisely convey momentum. And if the numbers aren't there, it's going to be really difficult to be able to get the attention of a venture capitalist.
And then Nate, I'll kind of go to you, same question, kind of like how do you stand out? How do you cut through the noise when everyone is kind of asking for money from kind of a shrinking pool of potential investors?
I think the one KPI that sort of stands out above all else is velocities, right? So if you talk to Carlton, CJ and James or Genevieve about the stars of their portfolio and go back to what were the velocities, Lemon Perfect or Goodles was doing in their first 500 or first couple hundred or first 1,000 stores, it was category leading, it was category defining, and same thing with us and Olipop, right? And when you can multiply that over 40,000 doors and even discount it by 50%, that's when the numbers become really big. And I think velocity, I'd take velocity over door count any day of the week because you can replicate velocities, right? There's only so many doors you can get in there. You can always sell more product though.
Is it also showing kind of what programs are working for you to achieve those velocities, and then also kind of articulating, hey, like we're going to deploy this capital because we know the levers to pull to drive that velocity?
I think it also just shows like is your product catching people's eye, right? So, we're looking at a brand that we really like right now, or a product that we really like right now, where the brand I don't think is very weak. Their website's horrible. The numbers are really impressive and the velocities are off the charts. And my first thought is, what if they have a great brand and a great packaging and great website, right? Like, what would their velocities be with that? And it just shows like velocities are strong right now. Imagine if they had a, improvement on everything else, right? I think it'd be off the chart. And so it just shows like how a great taste and the repeat purchases I think are really important, but velocity is above all else. I think it's the most important KPI we look for.
I think the other thing that's so important about velocities is they have a lot more trouble lying, right? So there's so much subjectivity that goes into, well, if X, Y, Z are true, how big can this get? Like, I mean, you look at one of the stars of Nate's portfolio, like Olipop, like, a number of things had to go right for the TAM, as large as it's been proven to be unlocked. And that's just a subjective conversation between founders and VCs and between VC partners themselves. But like what doesn't lie is velocity. Velocity points to what are the future large TAMs that people haven't necessarily articulated or considered yet. And then you start to go through a process of like, okay, within channels, can I project this velocity to ever, concentric enlarging circles as far as channel and consumer, and therefore this can be a much larger business than anybody else is considering. Like, the fact of the matter is, all the big winners are things that at some point there wasn't consensus on the size of the addressable market. Someone took early stage risk on how big that addressable market could actually be, and the only tools that you're legitimately going to have beyond founders having a reality distortion field and an undeniable grit and willingness to win is where it's on the shelf in front of consumers. Is it moving?
And then Genevieve, I guess same question to you. Kind of what are you seeing that cuts through the noise? And is it just a reiteration that like velocity is kind of king with everything?
Yeah, no, it's 100%. I mean, velocity, it does show the TAM. What it also shows is like early product market fit. You hear investors talk about that, and that's where, velocity is really where it's proven the most. So, I mean, I'd say that's, definitely huge. I think community and customer love is another thing that we really look at and get excited about. All of these, all of our winning brands, they have so much customer love and so much community built around them. And that really, I think, even more and more, that's what helps to drive that velocity. I don't want to not mention focus also. I think, one of the things that we get really excited about is when a brand has identified a hero product, or one or two, but one is even better, and they really know how to double down and push that and drive the repeat purchase or velocity within that, instead of thinking about like, okay, yes, you got to grow through innovation as well, but when you're really getting started, you need to focus and you need to make sure that you've got a winning product and that you're going to really drive home on that, whatever channel strategy that you're using. And the focus goes for channel strategy as well. That's something that we look at. It's like, hey, where are you proving this out? Do you have a good channel partner that you're diving in with? And is it focused enough that you can really get those learnings so that they can be repeatable? We often have seen companies, both in the portfolio and ones we're looking at, they'll get dispersed way too quickly because they're getting yeses from everybody. And that requires a ton of capital. And it also requires really understanding that who your customer is, what the message is, and how to get that across. And you don't always know that in the first year or two. It takes a while to get those learnings. So that's one of the things that we look for.
Yeah, and I'm not an investor, right? But I mean, we talk to about 30, 40 brands a week here, and it is palpable, the ones where you're like, oh, they have a clear plan, or they're divinely focused on what they're trying to prove, versus like this one's just trying to throw things against the wall and see if it works. And I think like that focus piece, if you can articulate that clearly from your pitch to your outreach to your meetings with the investor, is going to come through really well. One of the things I want to talk about, because a lot of the brands we talk to will be confused on kind of size of the round. And I think a lot of times think that they're doing themselves a service by asking for less. When we personally raised our seed round, we went out for like $1 million, and it was actually like a lot of investors were like, why are you raising so little? And then when we bumped it up to 2.5, it actually, the conversation started facilitating a lot quicker. And so Genevieve, we'll kind of start back with you, but like, are you seeing like, how does a brand go about just kind of that rudimentary question of like, how much do we raise? And I think a lot of the announcements that I'm seeing right now, especially on LinkedIn, it's great to see some newer brands do some fundraising announcements, because it feels like it's always the same 50 brands in a vacuum, but it's been much smaller Series A, is like 3 to 5 million. And so are we seeing round sizes kind of come down a little bit, and how do they approach just that piece of it?
Yeah, that's a great question. I mean, I think first and foremost, it's like, know what you're raising for. what, what is the amount you need to get you to that next kind of milestone or step change? That will really determine more than anything else how much you need to raise. It's like, hey, I'm raising $2.5 million, and that's going to allow me to expand in XYZ and get to this level of revenue and be able to increase my margins by this amount. So I think it's it's finding that right amount. I don't think that there's a blanket, hey, you should raise, a smaller amount or a larger amount. It's really kind of where you are in the business, where that money is going to get you, and then also who you're looking to partner with. I mean, because as you get into a Series A, there's, a lot of the Series A investors will want to have, a larger percentage of the company, which would require you to raise more money. And so it's like, does that make sense to have that partner? And is that money going to go to really get you to where you need to go and maybe not have to raise again?
I think one of the things too, like just throw seed and Series A and Series B out the window. Like none of that matters. Like we view the world as pre-scale, scaling, post-scale. And I don't really care what the round designation is within that. Like if you're in the pre-scale world, you're attempting to recreate ostensibly high velocities in one channel or even one retailer within that channel. Further, you're looking at either advancing your co-packer relationships or looking to vertically integrate your supply such that you can get on top of your margins, but all of them are projected forward. And a scaling decision is much more, okay, I've shown dominance in one or more channels and have lighthouse retailer accounts within those channels, and I'm looking to channel hop. And within the scaling, I might be looking for my forever co-packer, or I'm looking to substantially upgrade any kind of vertical integration I have from production. And then post scale, which is kind of classic growth investing, is for every dollar I put into my business, I can get $1.50 out, and that's why I'm raising this much money, to go out and close gaps and start to do a lot more above the line marketing. So I am always a lot more confident in teams that kind of understand where they are in that system, and they have completely accommodated their raise to accomplish the one or two things that they're trying to show, not I need money to continue to grow. I want to know what milestone you're trying to hit, exactly how much is that going to cost, so that we can evaluate what the valuation will be once you hit that, because with very few exceptions, that's not going to be the only round that you raise. So to me, there is no hack of how much, or other than more money is always going to give people peace of mind, especially when you're in the pre-scale and scaling times, because things always take longer and cost more than you think. But a really demonstrated fundamental understanding of what stage your company is and what 2 or 3 milestones are next on your path, and communicating how exactly you're going to hit them, is how you raise money.
James or Nathan, anything to kind of add? I think that was a great point, but James or Nathan, anything to kind of add to that piece in terms of like size of the round, kind of removing that from the conversation altogether when you're approaching the fundraising, or any tips you have there?
So there was a show on HBO a few years ago called Silicon Valley. And it mirrors so much of real life in this world. And there's a famous scene where the guy goes, I could have taken less, and has a nervous breakdown. I think that, so many people talk about, oh, we're raising $5 million, it's going to give us 18 months of runway, right? And I think the better thing is like, where's it going to get you? Instead of how much runway it's going to give you, it's like, what are you going to achieve with this, right? Because if you have a plan and say, we're going to do X, Y, and Z, and then you go do X, Y, Z, and A, B, and C, it's going to be much easier to raise money than if you didn't really clearly articulate the plan and go execute the plan. As I say to founders, execution solves all problems, right? Whether it's money problems, fundraising problems, team problems, sales problems. If you are able to execute, you'll be able to raise the money. I think always raise more than you think you need. right? Because it always takes more time and more money than, nothing's ever come in under budget in life. And so I think always give yourself a little buffer because the economy can turn, the world can turn, it can be more challenging. And I think you raise more than you think you need. That's kind of my level lesson.
Yeah, I think like it's structuring just a presentation around like we're raising X to get to X versus we're raising X to kick the can kind of 18 to 20 months. Like that is such a stronger vantage point right there.
Well, I think it goes even further than that, Cam. Like it's not about the presentation, it's about fundamentally how you're thinking about your business.
Yeah.
Like where are you trying to go? And I'm going to come back to the momentum analogy because I didn't do a good job of explaining like the underlying equation for momentum. Like I think about it through like a physics lens. Like momentum is mass times velocity, and in this case, like your mass is your points of distribution. Your velocity is how quickly it turns. And if your goal is, hey, we're going to increase our overall momentum, and through this money is going to help us build our distribution and maintain velocity, or we're going to increase velocity with this marketing spend, and we're also going to be able to grow our distribution, and here's how our momentum is going to be even more attractive for the next round. Like that is how you think about building, in my opinion. And as long as you are always in a building mindset and not in a how can we kind of keep the car on the tracks mindset, like you'll find that things will work out better, I believe, because like that signal that you're sending to everybody that you're talking to is like, hey, we have, again, to Jen's point, we have focus, understanding, and we have a goal that we are building towards, and that is what you're helping fuel.
Awesome points. I'll have one more question, but I put in the chat. Anybody who has questions, I will get to you shortly. Say hit the kind of hand raise icon, and then I'll start calling it on muting on people. James, we'll go back to you, but I wanted to kind of end my piece with just a question like, what are the biggest mistakes you're seeing right now from brands when they do their outreach or during the conversation? Is it just kind of a collective lack of the things that we've talked about, or what's kind of a red flag that could be easily avoidable from a lot of the brands that are reaching out?
I can go to
Go, Nate. If you got something, it sounds like Nate just saw on the screen. Yeah.
I think raising at stupid valuations and setting the valuation before you talk to investors. Like the easiest way to get me to say no is to tell me a valuation that makes absolutely no sense. Right? I had a call with a brand that I loved the other day. I love their product. I love their brand. And I said, how much money are you raising? And he told me the number. And then I said, well, what are you thinking about terms? And he told me the number. And I said, I don't think that's going to work for us. Like that's the easiest way to get me to say no really, really quickly. Because it just didn't make sense in any world that we are on. And if you set the valuation yourselves before talking to investors, you're only negotiating against yourselves. So let the market set your valuation and have realistic expectations, I would say.
Great points.
I think Cameron got kicked off, so.
No, I'm right here.
Like, there so that, like, smoke them if you got them. If you've got category defining margins and category defining velocity, and a narrative that you can talk about to get there, like you're welcome to try and set a very, very high valuation, but you better be as special as you think you are. Separate from that, it needs to be an ongoing conversation with funders and founders.
Oh, I also want to add one more thing. Sorry, this is gonna
Go for it.
I think you have to think about where you are today, but also like where are you going to exit, right? Yeah. Because if you're talking to investors, you need to leave room for them to make money. And a lot of these people, like 2 times their money isn't that interesting to them as venture investors, right? So if the biggest company in your category realistically has sold for $250 million and you're raising at $100 million, like that's probably not going to be interesting to a lot of venture investors, but if you're raising at $10 million and the biggest company is $250 million, that's much more interesting. So you have to think about how much can your investors make too.
Yeah, that was what I was going to kind of chime in on the back of Carlton there. It's like, even if you can get that high valuation for the reason that Nate just mentioned, like, I don't know that it's a great idea. It's like rather get a valuation that is based on multiples, that is it within the market so that you can grow into it. And then the next round, because what'll happen is sometimes you'll have a valuation that's so high early on that you'll already be precluding yourself from some good investors and good dollars later on because they're either expecting to have to pay a whole lot for it, or if they're going to go back to paying what are real market multiples, then your early cap table is going to get frustrated with you. It's because you're not able to live into those. And, again, it kind of comes back to the most important thing is making sure you have good partners and you have folks, investors that you want to build a business with. So those are, I think, yeah, valuation is definitely a big red flag. Other red flag, I mentioned it earlier, is like when you're raising, make sure that you have your shit together, know your numbers, have a good model, make sure you're showing your investors the most current version of everything.
It's very clear that someone sent Jen the wrong model.
Yeah, maybe this morning.
Just
And
very
it happens though. And then you'll ask questions and they're like, oh, wait, that's not right. And then they have a hard time getting you the right one. So I'm just, I'm going to drill that into your head because it's to the same thing as Nate was talking about. It's like if you've already set your valuation or if you already sent something, then you kind of lose credibility. And you only get really one shot to make a first impression. So, come with your best foot forward.
I think the last thing you said, Jen, is maybe like the biggest thing for me is like, how do you set your first impression? Like at the end of the day, I mean, you've got like Cam, you brought 4 people on the call here who are not passive investors. Like we're not just check writers that check in with the companies, once a quarter to say, hey, what are the numbers? Great. Talk to you next quarter. Like we are all actively involved in helping our companies grow. Opening doors where they otherwise would have ran through walls is an adage I like to use a lot. But at the end of the day, this is a partnership from our position. That's how we view this. And so it's more than just like applying for a job, making a first impression. This is, are we going to fundamentally understand one another through the lens of the business that you're building? Like we don't have to be good friends. Don't get me wrong. Like I wouldn't consider all of our investments, the leadership's friends of ours, but we have a lot of respect for one another. So I think it's coming to that conversation with a good deal of respect for both parties involved, and then seeing, hey, is there a fit here? Do we fundamentally agree with what we're trying to do? And you want to be along for the journey. Like that's how it works. And there are a lot of things that can throw that off the tracks, just like any other first date.
Yeah, and Malvina, I'll get to you in 1 second, but I just want to go back to Genevieve and Nathan, who kind of talked about valuation. Just want to set kind of the expectation, like the brand should not go out with a valuation that's set internally, right? Or from a current investor, you're looking for that to be set by an external investor. I think that's also something that I'm seeing from some of the brands that have current investors participating. Just wanted to get feedback there from Jen or Nathan before we kind of move on to questions.
It should be set by external investors or internal
Just like
investors?
the valuation, like are you coming up with that with like your internal investors that are already on the cap table and maybe like you're going out for next round, or do you prefer to see it set by the new kind of lead that's coming out?
It depends on what kind of round you're doing. Like if you're doing one of the club rounds, an internal bridge round, then if it's set by internal investors and they're taking the lead in it, then that's fine. But if you're looking for a new investor to come in and lead it, then it needs to come external. And what you'll see a lot of times is internal investors will be like, hey, yeah, I want to come in again, but I don't want to price it. I want the market to price it. So you'll see those things.
Okay, great.
I think it's also, for me, it's a check of like whether or not the founders have realistic expectations of their business. Right. So I remember I spoke to a company a few years back that was pre-launch, an interesting category, but valuing their business at $50 million. And like nothing to me is a bigger red flag than like that, because they have just massively unrealistic expectations of what their business is and what it will become.
Nate had a really good post a while ago where he dug up, like I think it was from 2017, like all the movers and shakers in food and beverage back then, and you can kind of look at what's happening in the ensuing 7 years, which is an acceptably long amount of time for seed investments to start to develop. And I think it's just really important that everybody understand that the reason we're all so focused on scale, velocity, and margins is there is really only one exit in the system, and it's acquisition. Like if I'm having a conversation with James internally and we say, well, who's going to buy this? And the answer is, well, maybe private equity. That's a good place to just stop the conversation, right? There are only so many slots that exist within the system for large liquidity events. And everybody's working backwards from those in terms of valuation. And like reasonable minds can differ whether or not we're entering into a time where there'll be more medium-sized brands because of certain trends. Like I'll just come back to human nature is human nature, and they tend to express themselves via brand and not subtly and not all that individualistically. So you have to work back from what success can look like and understand where the acquiring universe is going to develop the liquidity that everybody wants here actually exists, and how hard it is to make it to the end of that.
Yeah, I mean, CJ and James, we talk about a lot about like those zombie brands who get to that like 8 to 12 mark, but just like can't break through that next threshold. And like there's not really a home for them a lot of times, right? And so that can be difficult. And so showing that story is definitely important. All right, Malvina, you've been waiting patiently, so I'm going to ask to unmute you and feel free to ask your question.
Hi, thank you. Thank you all so much. There's been a lot of talk about CPG, and I'm questioning what is the appetite for food adjacent, food related products that are not at CPG. So I have a hardware enabled SaaS platform that provides nutrition literacy for families. Questioning what is the appetite there in terms of investment if you had the velocity and all those other factors, or is that outside of the scope for most of you?
I mean, I without knowing much about your company, we do like what we would call commerce infrastructure or commerce tech. If I'm hearing you correctly, your B2C hardware, which I'm not an expert in, so I can't I'd have to think about it a little bit to kind of keep you eyes on what you should show for progress, as we haven't done very much B2C hardware. Jen, have you done any B2C hardware? I think Jen's on mute.
We have a B2B play as well, but go ahead, Genevieve.
Yeah, no, it's not something we would do. We tend to stay away from hardware.
Thank you.
And I'll never say never to anything, but it'd be a long putt.
Thank you.
I think the other thing to add on to what Carlton and James were just saying about acquisitions, you look at Red Bull, which is what, the fifth largest beverage company in the world, something like that. I don't think they've ever bought another brand ever in their history. And so like there are categories that are harder than others, certainly.
Awesome. Zoe, I am unmuting you. There you go. You're good.
Hi, everyone. Thank you so much for sharing your time and expertise to help founders like me. I'm the founder of Bin Bamboo. We're a tree-free paper company. We have been raising, and there are two questions I have for this group. One is pretty straightforward, and the other is maybe not. So question number one is, hey guys, could you keep it down for me just for a sec? Thanks. Okay, so the first question is, what would make you not want to invest in a future round, whether that's a bridge round or otherwise? I'm just curious if you could share a little bit. Like we're not at that point yet where we're raising another round, but I know that I have competitors that are, and I think that they're having a really tough time. So I'm curious if you could give a little insight there. The second question I have is, could you speak about moats, patents, protectability for either the brands you invest in and what motivates that? It's a big piece of feedback we've been getting is you need to build your moat. And I'm curious if you could share, like, for other founders that are also raising, what that means in the CPG space.
I could address the second one first. My wife is a patent litigator, so I know just enough to be dangerous here. Like when we're talking about true IP, and not soft IP like brands and trade secrets. When we talk about true IP, it's really reflexive, right? It matters. Having that stuff early and a patent moat is important, and it becomes more important the better the business does, right? Because it's very difficult to have the the wherewithal in the treasury to go out and like actively enforce patents. It's an extremely capital intensive game. Your acquirers can care a lot about it, because they're in the business of enforcing their IP. So we do a lot of stuff based on pretty deep IP, like Zbiotics, like Vertosa, and it becomes significantly more important as you scale and as you prove out the actual consumer desirability of the thing that you might have an IP moat around. So important at early stages to let people know that you have it, but don't expect that to be the one thing that moves it forward. And the more successful your company gets, the more valuable that IP gets, especially if you're able to jump it into other categories, et cetera.
I'll mention something just on the first question that you asked. There's a lot of things that could complicate why we would or wouldn't come into a second round when it comes to like round structure. But one of the things that we see is having the founders not have enough equity in the company early on. Because that really it's de-incentivizing, and if the founders don't have a lot of equity, then you're backing somebody who is already kind of demotivated. And we also don't want to have to be diluted to get your equity back up to where it needs to be. So that's something that as you're raising kind of early rounds, just to keep in mind. There's other things as well, but I'll leave it at that.
Awesome.
I want to touch one thing on the second part, because I don't know if Bim Bamboo has a patent, or if the feedback that you're getting is, why doesn't everybody else just do this? And like, it's a conversation that we have all the time about anything that's a challenger brand into an existing category. It's what happens if Frito-Lay decides they want to make this, and the answer to that most often is like, big companies are big ships, and big ships turn slowly. So even if they want to do it, they're going to spend millions of dollars internally trying to figure out the supply chain, trying to get to a place where it makes sense. And oh, by the way, in the amount of time it's going to take them, we're going to be acquirable. So why would they spend that money to try and build something to compete with us when we're going to be proven in the market? We'll already have established distribution, established velocity, the community that Jen mentioned earlier that they'll be able to bring into their fold. And we're going to be an acquisition target. Like, that's the answer that most investors want to hear. And then they're going to go and try and make sure that's true. But so often, I think investors fall back, or you'll have conversations with people who maybe don't do a lot in this space, who will say, well, what stops somebody else from doing this? Nothing. Like, nothing stops anybody from doing it. But that's why you're an entrepreneur and they're not, is because you saw an opportunity and you went and chased it. And the right partner is going to recognize that, support that, and line up behind you to give you support.
Yeah, I feel like almost if an investor gets hooked up on that, like, it's probably just not the right fit for you, and they're going to believe in the company or the brand that you're building anyways, which is probably the answer there. All right, well, I know we have a couple more minutes. We probably have time for one more question, if anyone has any. If not, we'd love to just get like some closing remarks from kind of everybody on, I know we're in a really strong kind of 6 to 8 week window here until kind of everyone breaks for the holidays, where like a lot of the deal flow kind of happens here, and a lot of investments happen before the end of the year. At least I know that is the case on our end with a lot of SaaS companies. But we'd love to just kind of, James, we'll start with you because you're popping up here on my screen, and you and CJ first. But like, what's the best way to kind of maximize these next few weeks before the end of the year?
Network. It sounds really simple, but things that are simple are often not easy. and like networking is your biggest tool as an entrepreneur to fundraise. You know, there's like plenty of things you can do when you're on a flight. Talk to the people next to you. Like, if you're always thinking about, hey, I might be one or two connections away from somebody who unlocks a lot of value from my business, and that's how you kind of go about your all everyday interactions, I think you'd be surprised that you may be able to network your way into a conversation. But I know that for us, you know, an introduction from Nate or from Jen or from Cam goes a lot longer than a cold email. And so it's finding ways to network your way into conversations. I'd say, like, and that goes from beyond just this period of time, but like always think about how you can get yourself in front of the right people.
If you're trying to get a raise done in the next 6 to 8 weeks, it's going to be whatever it's going to be. So you know, I don't have as much advice for that other than, you know, get your narrative right, get your scale right, et cetera. For those who are on this because they're starting to think about raising, like the single best piece of advice I can give you is start early so that you can develop relationships with people where you can demonstrate execution. Like that's like that is the easiest thing in the world to do, and it's the most powerful thing in the world to do. Start talking to the people you want to be your investors. Say, I don't want money from you now. Over the next 6 months, I am going to do X, Y, and Z, and then I'm going to want money, and then do X, Y, and Z, and you will find that your raise is an order of magnitude easier. And that, I mean, like I've now seen it work so many times. Like do the hard, boring work of sending out investor updates, get people on your investor updates list, and don't just look for good news. Like lay out your goals, talk about how you're going towards your goals, and then develop ongoing conversations with funders, you know, to the point, because if you can get me to nod my head when you're saying this is what I'm trying to accomplish, and once I've accomplished that, I want money, and then you go out and accomplish it, you're just infinitely more likely to get investment.
I just want to like really harp in on the investor update thing, because I think that like there's value in the communication that you're sending out. There's also value in the preparation. It keeps you on top of what it is that you're trying to accomplish internally. It helps you set not just long-term goals, but short goals. Like, hey, here's what we're going to get done over the next quarter. And it builds a pattern of accountability that's good for your company, that's good for you. And it has the added effect, as CJ mentioned, of keeping the people that you eventually want to be your partners in the loop.
That from the founder's perspective, PaperStreet is a great platform for keeping kind of your updates and staying on track with that. So paperstreet.vc, I think, is the website, but like is what we use, and they do a great job of keeping everything organized. Nate, do you have any kind of closing remarks on that piece?
Jen's been trying to say something, but she's been muted.
I know. I just can't get the Zoom thing 10 years later. Yeah, I would just second what they're saying. I love getting those updates, and I love it when they're short bullet points. Like, don't write a novel. Like, we're not going to read a novel. Just put it in bullet points. We said we were going to do this last quarter. Guess what? We did it, and then put the number. Just like make it as easy to digest as possible. Second thing I want to say too is what Nate mentioned this earlier on. It's like, a lot of you may not want to take money from us. Like, you may need to have a different financing strategy. And so explore that to the fullest. You know, I think that there really are only a few brands that really should be taking venture capital, but what are some of the other ways that you can finance a business? So really dig into that before you just go down this venture path. I think, you know, a few years ago, it was like, oh, so sexy. Everybody's on Shark Tank. Let's do that. But it's not that sexy. So figure out a way to fund it and grow it without us if you can.
Ironically, if you have tremendous velocities and very good margins, you're an excellent candidate for debt. Now, debt's super reflexive, right? As venture capital becomes harder to get, so debt gets harder to get. Like there, and that becomes a macroeconomic story. But all the things that make you able to raise venture also enable you to raise non-dilutive capital as well.
My piece of advice is like from the great words of Ted Lasso, be a goldfish, because it literally, fundraising, you have 1,000 conversations and it could be 1,000 no's, but your 1,000 first could be a yes. And really all it takes in this world is one yes.
And we can all speak to that because we've raised the money that we're deploying. So we've been through that journey too. And I think understanding that and leaning on the people, whoever they are in your lives, who have raised money to get advice on how you manage through that is helpful.
Awesome. Well, thank you all for being here and providing such great information to all these brand partners. I know we had almost 200 people sign up, so we'll get the recording out to people that couldn't make it. I know you don't want your inboxes littered with a bunch of people reaching out, but what I'll do is I'll provide some, for the investors that are okay with it, in the recording that we send over, we'll send kind of like the general kind of inbox and stuff like that for outreach. So hopefully you can kind of skip finding a warm intro for at least the people on this call. And yeah, again, thank you everybody for attending. Thank you the investors for participating, and have a great rest of the week and start to Q4.